Today, we're going to take a look at where we are year to date with the market. We're going to talk about the COVID-19 virus pandemic. We're going to talk about what's happening in the market today and this year. So here we are on Monday, March 9th, 2020, and we have had quite an eventful year in the market so far. As usual, let's just start out by taking a look at the market performance year to date through mid-morning today on March 9th. You can see the three market segments that I like to track. The blue line at the top is the S&P 500, down about 12.9%. Today it's been down a little bit lower. The red line is the Morgan Stanley Europe Australasia Far East Index, and that is down about 16.4% year to date. And the green line is the S&P Small Cap 600 Index, and that is firmly reached bear market territory, down 20.43% for the year. The all-time peak of the S&P 500 came in mid-February, around February 19th. So you can see the all-time high of the S&P 500 on this graph. So the up slightly for the year. So our total decline from the peak of the S&P 500 is probably closer to 15%. Because we did see a little bit of a bump up in the beginning part of February before things all went to hell in a handbasket. Here is the S&P 500 again as of mid-morning, declined to about 21.2. So you can see that is down quite a bit from the last couple of years. We had a little bit of a retrenchment last year, a little before that, and the red line indicates where that PE ratio would have been as we go back to 1870 as the markets have been reconstructed. So a little bit of a pullback in the S&P 500 as the markets have pulled back, and that's not necessarily a bad thing. Here we are with the S&P 500 earnings using estimated earnings for the trailing 12 months. And you can see, might discern just a little bit of flattening of the growth of those earnings over from the last quarter on this graph. And again, I think analysts are probably busy this week trying to figure out their forecasts for the next 12 months for the earnings of the S&P 500. Obviously, some of the larger multinational companies probably going to take a hit in the first and second quarters of 2020 due to interruptions in their business in China and Asia, as well as many companies in specifically affected industries and sectors probably going to take a little bit of a hit as well, but we'll talk about that as we go. Today, when the markets opened, they immediately went and circuit breakers were triggered that halted trading. The circuit breakers, this is a policy of the major markets that when the markets go into free fall after a certain point, trading halts go into effect, and that allows people the traders and market players to kind of regroup and slows the fast descent, so markets don't continue to over-exacerbate their downward spirals. News overnight came from the Middle East, where Saudi Arabia and was in disagreement with Russia over oil prices. OPEC didn't come to an agreement with Russia, so Saudi Arabia slashed the Brent crude oil prices, and that, or rather their crude oil prices, and that just triggered a lot of response around the country. It's thought at this point that Saudi Arabia is probably going to keep the pressure on for the remainder of the year, at least for some for the foreseeable future, and keep those oil prices low. And that interestingly, may have a positive effect on the American economy, at least offsetting some of the problem areas. If fuel prices, gas prices go down, that could be a mitigating factor that might help keep the country from going into a recession in the face of some of the other concerns. But again, this is all just new information, so the market needs time to process it. Of course, ongoing concerns about COVID-19, the coronavirus continue to play out in the media. I think right now we're in a chaotic situation where there are a whole lot of unknowns and a lot of confusing advice from authorities, and that's causing some people to react in a near panic behavior pattern, both in the markets and outside of the markets. And not taking a lot of comfort from the few words that have been coming from authorities about the overall impact, and just a lot of misinformation, a lot of disinformation, a lot of confusing information. Jim Cramer this morning pointed out, or that the chaos right now in the markets is probably a whole lot more confusing than during the financial crisis. And certainly there's a global aspect to the COVID-19 and the overall impact. And since we are in early stages of it here in the US, the concern is that we just don't know what's the scope and scale of the epidemic. How severe is it going to be? Will various authorities in areas and cities and institutions be able to forestall the spread of the virus? Will we be able to come up with a vaccine that will help mitigate the effects of the virus, and remains elusive, as with all viruses. So I think that's a big driving factor. A little bit more about that. The big questions that are looming out there seem to be: are we headed into a bear market? Certainly with a correction already in effect. Most market observers would agree that we are in correction territory. So is that going to continue those downturns and take us into a bear market? And then also concerns about the economy. Are we going to enter a recession? Are we likely to enter a recession? There have been economic concerns for many years now, many quarters, as various segments of the economy have posted results that are less than had been hoped for, while other segments remain strong. So just adds one more confusing piece of the puzzle for those people who like to try to predict where the US economy is going. Well, let's talk first about how markets have responded to world epidemics, health epidemics in the past. As a student of market history, I find it useful to review how the markets have responded during past bear markets and past corrections and past recessions, and the same can be done by looking at the response of markets around the world when we've had epidemics in the past, and we have had a number of them. And I guess it remains to be seen if COVID-19 will be one that has a greater impact than epidemics in the past. But certainly some past global epidemics and pandemics have taken their toll on the markets and have had an impact on the areas of the country that they have affected. So here is a graph. There's a lot of information here, but this comes from Charles Schwab from their Center for Financial Research, and it looks at epidemics and the global market performance. So the blue line that you see here is the EFA, the Morgan Stanley World Index. I'm sorry, it's the World Index, not the EFA Index. And that will look at the overall index of world stock markets, and they have plotted on here a number of epidemics, starting with HIV/AIDS that began in June 1981, the pneumonic plague, which hit in September 1994, SARS, if you recall, the avian flu, dengue fever, swine flu, cholera, MERS, Ebola, measles and rubella, Zika, more measles, more Ebola over time. And they've calculated the 1 month, 3 month, and 6 month returns after these epidemics started. So you can see on these graphs that the actual start of these epidemics or health events, health-related outbreaks, doesn't correspond. You can kind of visualize it, that the markets tend to move upward afterwards. There have been a couple where only a few where after 6 months the markets were down markedly after particular health epidemics, so pneumonic plague, HIV, Zika, Ebola. But even swine flu and avian flu, which certainly got a lot of media outbreak or attention after those outbreaks, the markets were up markedly after 6 months. In 1 month, yep, we get a lot of negative market returns, but the number diminishes after 3 months and goes down after 6 months. So this, I think, speaks to the resiliency of capital markets around the world, and also the pace of information dissemination in the 21st century, even greater than it was 30, 40 years ago. And now we're seeing lots of information that's known. It's known faster than ever. People attempt to make decisions based on the fast delivery of information without kind of concern for accuracy or taking time for reflection. So there is definitely a trend here that yes, there's a short-term impact when these health related events hit, but after a certain period, the market resumes its general upward trend. Here is another look at the S&P 500 performance around global health emergencies. And a number of epidemics, including SARS, bird flu, swine flu, the wild polio virus, Ebola, and the Zika virus. The dark blue line is the average of the S&P 500. And so this from Ned Davis Research shows you what the markets were doing 12 months before and 12 months after the event date, according to when these outbreaks started, as determined by the World Health Organization. And so again, you can see sometimes the markets were already in a kind of downward pattern, and they didn't continue after those declarations of emergency. Other times the markets generally, and certainly on average, the S&P 500 is higher 12 months after than it was at the time of the declaration. So that's a very US-centric view of global health emergencies. Certainly when we look at SARS, bird flu, swine flu, Ebola, Zika, had fairly minimal impact on the US, and so the markets may not have responded in the US quite as severely as they will for COVID-19, which is already, there are more cases, more widespread being reported in the US than some of these other factors. But again, the trend is that the markets do recover, that the impact is not necessarily very long-standing. When you think about the resiliency of the US stock markets in the last 40 years, besides the epidemics and pandemics, we've had market crashes, as in 1987, the Gulf War, and the financial crisis of 2017. And it's pretty clear the markets will survive COVID-19 as well. And so that is something that I think I can state with a fair degree of certainty. We don't expect catastrophic meltdowns. Certainly, there are people who profit from short-term market-related panic, and it's in their interest to share as much negative information as possible. But I think in the long term, again, I wish that we all are healthy, that we take the necessary precautions, but let's not over-respond, and especially with our portfolios at this point. And we'll talk more about some guidance in that area as we go. Right now, it's clear, yeah, airline stocks, cruise lines, hotels, casinos, travel companies are getting hard hit, especially related to international travel. And I guess the timing, not so good for China with their Chinese New Year and a lot of people socializing at this time of year. But for those of us in the U.S., this March, April, going into May are not necessarily the biggest travel months until we hit the summer vacations coming up in June, July, August. So yeah, those kinds of companies are being hard hit right now. Companies that are connected to China, companies that operate, have a good or a significant business in China or with China or rely on products or parts made by China, are certainly going to be affected as their workers are being quarantined and their production is dwindling down to very, very low levels. I guess perhaps one upside of the tariff battles of 2019 is that a lot of American companies sought out, made contingency plans, or found new suppliers for parts and components that had been coming from China. And so certainly going to take a toll on China and the Chinese economy with their declining production, with probably already slowing down a little bit based on some of the trade wars. But that is, hard to measure the actual impact of that on most companies. And yeah, our approach to investing doesn't rely on trying to catch trends in the short term and benefit from short-term market moves. I still see a lot of people wanting to know where they can invest in companies that are making masks and respirators and antiseptic products, and certainly the companies working on vaccines and treatments, pharmaceuticals. But most opportunities have already been bought up and run up to very high prices, high valuations. So the herd is already, for over the last couple of weeks, bid up many of those stocks way above any potential that their fundamentals would support. So I don't see any place to really look for opportunities to profit from the current situation. And again, our focus being on the long term, being based on fundamentals, is to look at companies on a case-by-case basis and look at ways to find opportunities for companies that will perform well over the next 5 to 10 years that are just available now at reduced prices. So we'll talk more about that as well as we go on here. I also wanted to know, or wanted to talk about bear markets and corrections just a little bit, because obviously with our 10% decline from the peak, greater than 10%, the Dow and the S&P 500 are generally considered now to be in correction territory. And a bear market would be a decline of 20% from the high. Small cap stocks If we look at the S&P 600 at least, and the Russell 2000 are probably already in or very close to bear market territory, again, depending on which index you're following and your specific definition. But small caps probably already in that situation. Somewhat ironically, because small company stocks tend to have less global exposure, so they're more focused on the US. Small company stocks are not generally involved in high capital industries like airlines or hotels or travel businesses so much, but they get the trickle down effect as bigger businesses contract. They see their opportunities diminish a little bit as well. It's important to recognize that sectors and market segments can have their own corrections in bear markets, and certainly energy stocks have had a rough run this year. Now with oil prices going down, that's going to make things a little more problematic. Again, if oil prices do continue to fall, that could impact utilities positively because they might have lower cost of generating electricity. There could be some concerns there, again, depending on sources, et cetera, et cetera, et cetera. So we look at these different market segments, and the advantage of our approach about buying good companies, regardless of industry and sector trends, allows us to kind of find the best opportunities if there are particular segments that might be underperforming. So if we're in a bear market or in a correction, does that mean that a bear market is likely to follow? And the answer is no. Since November of 1974, we've had 22 different market corrections in US markets, and only 4 out of 22, which is less than 20%, became bear markets in 1980, 1987, 2000, and 2007. That's a long time ago, 12, 13 years now since our last bear market. And then it was 7 years before that, and then it was another 13 years before that. So we have a whole lot of investors in the market who don't have very much experience at all. So I wouldn't. I would caution anyone at saying, well, this is obviously conditions are ripe for a bear market. Bear markets are unpredictable. The timing, the length of them, they're just not predictable. And our approach doesn't depend on knowing where the markets are going, where they're headed. Are we in a bear market? Are we headed for a bear market? It's possible that we could be headed for a bear market. But if we look at history, we'll learn that it doesn't really particularly matter. And to most of us, if our strategies are set correctly, corrections by themselves can be very healthy. I've been waiting for this correction for some time because of the excesses in valuation for a lot of companies. Again, it's supported by a macro climate that investors are putting their money in the stock market because there are no other options. The Tina effect. There is no alternative to stocks. That means people are not keeping their money in CDs or interest-bearing accounts because interest is so low. Now interest rates have gone down once again. When the Fed cut rates, so that's making cash-bearing accounts even less attractive. Bond yields are kind of similarly so low that a lot of investors are looking for bond proxies, like a real estate investment trust or other interest-bearing or distribution-paying type of scheme. But a decline in the market, a 10% cut to valuations, is not necessarily a bad thing, and so it can kind of wring out a little of the excess, brings the prices back down to closer to the long-term trend. I've been waiting for earnings to catch up to valuations, and that's a long waiting game. It's more likely that we would see valuations contract a little bit and let the fundamentals of the earnings and the earnings power of companies drive the valuations a little bit more. So this 15% decline could be a good reset. Interestingly, this morning, if you were watching the market after the trading halts went into effect at, I think, somewhere between 7.78%, when the market came back, there was a lot of buying going into the market. So the level that the market had gone down was only about 6% for the day. So that was, again, some sign that people are not staying away from the market entirely and looking for opportunities there. So having said that, do we know, will this correction be a healthy correction? Well, that all remains to be seen. Certainly the next couple of weeks in the market as the COVID epidemic plays out are going to be very interesting, very telling. Certainly, we've got many months ahead of economic forecasting and quarterly reports on GDP and company profitability. I would expect to start seeing some companies perhaps doing some early reporting of results in advance of the March 30th deadline, kind of priming the market for downturns from a lot of companies. I think it's important to remember that for many companies, this is just sort of a pause in their fundamentals, that sales are not necessarily going to go away. They're just getting deferred for a quarter or two, and then I would expect a rebound to happen. Again, that's a big generalization, but it depends on what happens to the economy if we do have a recession there. So let's talk about if we do have a bear market. Since 1966, the average bear market has lasted roughly 17 months, and that's much shorter than the average bull market. So that average of 17 months is even less when you look history of bear markets, so not going back to 1966. So keep in mind that if we do go into a bear market, it could be over in the matter of a few months. Our 2007 bear market was about 10 months. So before you know it, we could be back on the upward trajectory. It just makes it even harder to kind of predict if you have an approach that requires knowing where the market's going. It's just nearly impossible. And so for long-term investors, staying the course is often the best. Here's, as I mentioned, recent bear markets. So those are the red blocks in negative territory. Have tended to be much shorter than longer corrections. So I guess the 2007, maybe that's closer to 17 months, but you can see the big blue marks are the bull markets. The red blocks are the bear markets. So this graph is very interesting from the Schwab Center, once again, because it shows you the strength of the bull markets and the length of the bull markets compared to the strength and length of the bear markets. And the fact that this graph is mostly blue and mostly big blocks tells us that we should keep in mind that the market's upward bias continues and will continue into the future. The average duration of bull markets since 1966 has been 2,300 days, while the average bear market was 512 days. So let's not change up our strategy to accommodate the shorter duration of bear markets and focus on the longer duration of bull markets. Here's another graph going back to 1920 something of the bull and bear market history, again showing us that the big blue blocks of upward motion are way outweighing the bear markets in red as they decline. So keep those in mind, keep those factors in mind. I often quote an old German proverb that translates to, in the imagination, the wolf is always bigger. And I think that relates to bear markets, because in the imagination, a bear market is often portrayed as a nasty, painful period with lots of losses. And yes, the losses can be significant, but they tend not to last very long before the market recovers and moves upward just again. So right now, let's think about Warren Buffett, who famously said, be fearful when others are greedy and be greedy when others are fearful. And I think we are in a situation right now where others are fearful. And so I think that's a sign for those of us who follow the longer term principles of buying good companies at reasonable prices, that we're provided with a lot of opportunities to capture those assets. And Sherelle makes the comment, shouldn't we be buying on the dip? If so, what markets? Well, right now, I would suggest that it's too late to take corrective action in your portfolio, as it always is. The time to think about bear markets is during bull markets, and to think about the defensive portion of your portfolio. And that's something that I've been talking about for years and years and years, it seems, just kind of pounding home the point that it's always a good idea to be thinking a little bit defensively about your portfolio. The risk of a recession or a bear market has always been there. It's just we can't measure the likelihood of a recession or a bear market. So thinking defensively is very good. You can't invest in the market and have a strategy that says, well, when a bear market comes, then right before it comes, I'll make some adjustments, because that's not the way the market works. The market doesn't allow you time to make adjustments when we're in a particular phase. So right now, there's nothing to do to protect yourself. The market could bounce back later this week, later this month. I think that there's going to be some chaos in the market. I think that will be the theme for the next several weeks, maybe the next couple of months. But at some point, we're going to have the opportunity. A lot of opportunities present themselves for those of us who are on a longer term horizon with our portfolios. You should have a plan for the markets, and this is not, which should incorporate what to do during bear markets and what to do during bull markets, what to do during recessions, what to do during expansions of the economy. So we're going to stay the course. There's no need to change your plan now. It's already too late. If the S&P 500 is down 15% from its highs, then there's the time to have taken action to prevent that, if that was your goal, would have been back in early February. But again, there was no way of knowing what was going on. So I think right now I would suggest that there's no rush to go out and buy stocks. There's going to be plenty of time to review candidates, make purchases of stocks at reduced prices. I saw a discussion earlier today, someone who was suggesting that in Texas Hold'em poker, there's a notion of going all in when you've got a winning hand, where you bet everything, and other players can either go all in or they can fold. But if they go all in, the winner takes all. Well, that works for poker. It doesn't work for investing. I wouldn't say it's time to go take all of the cash that you might have been sitting on looking for opportunities and start buying this week. But hey, if you have some cash and you want to put 10 to 15% of it into the market this week, when you find a good opportunity, maybe to double down on a stock that you own that is selling at a particularly attractive price, I think that's fine. But just keep in mind that the downside is very real from this point. So we could see another, 10% decline in the prices of your portfolio just from the resulting volatility of the markets where we stand right now. So that should be factored into your thinking. Again, we don't spend a whole lot of time thinking about the downside of our investments. Certainly on the stock selection guide or in toolkit, there's the opportunity for you to measure the potential downside. It might be useful now to revisit your portfolio and revise those expectations and just think about how it would feel if all of the stocks in your portfolio reach their downside prices. Now, it's probably not likely to happen. There'll probably be some companies that don't decline as much as others, but certainly I'm looking at a lot of small stocks, seeing a lot of them in the red this week, this month, and again, that for me is normal volatility, and again, the prospects for those companies probably not likely to change significantly because of current global health and economic factors. But again, there are a lot of unknowns and a lot of mystery, a lot of chaos. But for now, we're just going to stay the course and continue to try to find the best opportunity for our stock portfolios. So if you have any questions, please feel free. Otherwise, we'll wrap this up. I did want to share some thoughts on the market. I did write an editorial for the Small Cap Informer week before last on the epidemics and pandemics, and I'll be publishing that on iClub.com or on the Small Cap Informer website if you're not a subscriber, which has just some thoughts about the length of global epidemics and their impact on markets. I've ideas today, but importantly, I wish that you all are able to stay healthy, act prudently without panic. I don't think we need to carry around our Lysol wipes with us every day, but if you are traveling, wash your hands, use hand sanitizer when prudent. I don't think we all need to buy hazmat suits and respirators. Certainly, if you have a compromised immune system, it's important, especially for you, to take all necessary precautions to remain healthy. I'll be traveling to New York City tomorrow. I'm traveling to Detroit by plane on later this week, so I'll be staying in hotels, and I'm going to be, doing my best to remain healthy and cognizant and avoid stadiums and coliseums and concerts where there are a lot of people, and be aware of my surroundings when I'm in the airport and on the airplane, but otherwise I'm not making wholesale changes. Obviously, people who are going on cruises are reconsidering like crazy, and international travel, depending on where you're going, can be something to reconsider. But in terms of your portfolio, I think if we all sit tight for a couple weeks, that would be probably one of the wisest things that you could do. Certainly, trying to dump stocks now to get out before a bear market could be detrimental to the long-term health of your portfolio. So I've got some trips coming up. We'll see how these all pan out, and in the spring into the summer. Hopefully conditions will improve, but I'm still got a big schedule coming up of Better Investing and Money Show and AAII events. I've added in another event in the Washington, D.C. area in July since I put this slide together, so I'll be down there as well. Joe says, will governments increase their debt? One last, oh boy. Well, the U.S. Has just been on a real rip, increase our spending and increasing our deficit at a phenomenal rate, and certainly cutting interest rates is not going to help that situation. Um, the from all appearances, China, which is sort of ground zero of the COVID-19 coronavirus outbreak, has been very proactive. Certainly, other Asian countries. I had a friend who traveled to South Korea a week ago. Her daughter was on a university exchange program, and so she went over to help get her daughter out of South Korea. And they went to all the tourist spots because there was no one there. So they were able to go to squares in Seoul and museums and parks, and there was just nobody out except the police, and everyone's required to wear masks, and they're all staying home. I know also here in the US, a lot of companies are working on their work from home plan, getting their employees set up so that if they do need to quarantine, that they can continue to maintain operations. And so um, uh, Will there be wholesale increases in government spending? Certainly a little bit, but I think it's really difficult in the U.S. to kind of identify if the spending has been cut in so many areas, so it's going to be more expensive to ramp up some of the pandemic centers that have been closed if we need them. I think that again is just part of the great unknown about the markets. On the flip side, again, the Fed interest rate cut has pushed mortgage prices down. So if you didn't refinance the last time interest rates were this low, there's an opportunity there, and a lot of people. I've heard from from a friend who works at Quicken Loans that they've been, the mortgage rates that home buyers are able to get right now are really terrific. So again, that's not going to last forever, but there's an opportunity there, and that could help support the housing industry, which has been really strong. Might see some pullback, but again, you can look on a sector by sector, industry by industry basis, and go through and try to identify opportunities and hazards. But it's all going to come out in the next couple of weeks as companies report first quarter earnings. We're going to hear about the scale of those particular companies. I did see, this morning, all sorts of pundits are coming out with ideas. Certainly the FANG stocks, Google, Facebook, Netflix, Amazon, are probably, if you can buy those on the dip, those are great long-term opportunities. REITs and mortgage REITs, again, you're getting some distribution there. Those could be some positive opportunities. We covered in the issue before last, I looked at a company called Owl Rock Capital Corporation, ORCC, and that has been has a declared distribution for the rest of the year based on some undistributed income that they were distributing on a requirement similar to REITs, their business development company. The forward yield based on their estimated distribution that they reported and on the actual distributions that they reported that they have to make according to regulation, push their yield up to 8 or 9%. So that's a really interesting business. They fund mid-sized businesses that are often very recession resistant. So it sort of hit the sweet spot of here's an income opportunity with some growth that won't be necessarily affected by a recession. So that company is Owl Rock, OWL Rock Capital Corporation, ORCC, and it's pulled back in price since we featured it, and it's one of the companies that I'm looking at personally. I think might be a good opportunity when you because it's the price of the stock is very close to the net value of the businesses that they own. So you're able to really kind of get in at a discount right now. And so that's an interesting opportunity. Certainly hotel REITs are going to get pounded, I would imagine. So, but there might be some opportunities for some higher yielding businesses there. Grocery stores, retail, you know, we'll see how the shakeup goes with bricks and mortar versus e-commerce. If people are staying home and shopping online more, we would expect Amazon to have a great quarter, and even Walmart, where you can order online, drive to the store, and they'll bring it out to you, so you don't have to actually go into the store and interact with people. Seems to be a trend that's been in place now for many years, coming to its most obvious conclusion that we can actually live our lives and not have to actually interact with people on a one-to-one basis or a one-to-many basis, just from the comforts of our own homes and living rooms. But we'll see how that goes. Anyway, hey, well, thank you all for stopping by this morning. Good luck in the markets. Stay the course, and we'll look forward to seeing you at our next Lunchtime Stock Club webinar.